therefore it is representing a store of value. Again, it should continue to do well, as will silver, and we think every individual should own a significant percentage of precious metals in their portfolio, probably in the range of 10 to 20%.
We'll move on to the U.S. dollar in just a minute, but what about the news that Barrick Gold is going to eliminate their gold hedges altogether within the next 12 months? Did that surprise you? And I think they were taking a close to $6 billion charge this coming quarter to clean that up.
I haven't followed them specifically that closely, but it really doesn't surprise me. I mean, companies, smart managements do what's good for them, and they realize that there's an upward movement in the gold price, and why should they be hedged? If you look at the massive changes that have taken place, in the gold market just in the last month or so that have essentially helped create this pressure, through $1,000 in the gold price. The fact that the Chinese are now encouraging their individual citizens to go out and buy gold and silver. The fact that the Germans, I just read yesterday, are asking for their gold back from the New York Fed. The fact that Hong Kong is taking back their gold from their London holding, from the fact that Barrick making this move relative to hedging. There's various moves afoot. Greenlight Capital has sold out their ETF gold position and buying the physical bullion. All these moves are occurring in the gold market that I believe are indicating that we may be at a launching point in the price of gold that could surprise even the bulls.
And I would also point out that that's normal as you go through a bull market, that you begin to have this institutional and smart money begin to come into the market pre the mania. There's also a quote on your website. The question is not whether the dollar will weaken over time, but how it will weaken. The real risk is that you will get a disorderly decline. And that was from Mohammed El-Arian from August 19th of this year. What about the dollar, David? Where do you see that longer term? Obviously lower, but talk to me about the dollar.
I tell you, Eric, we're going to face a standard of living decline in this country. We're at truly science experiment levels here, because the dollar being the world reserve currency and then our policies of fiat money that have grown so extreme, and the fact that the global system is reliant upon what Doug Nolan, our Chief Portfolio Manager, Prudent Bear, my partner who's worked with me for the last 10 years, has talked about this being a dysfunctional global system where the rest of the world worked hard, saved money, and sent us money for us to spend, and then we sent them back paper. And now, this system has come unglued over the last 18 months, and now we're going to have to transition away from this system. And therefore, the system is broken. We need to revise Bretton Woods. We need to get back to a new currency system. That's what the UN and the G20 are talking about. And it's going to be very interesting, and it's truly going to be very uncertain and unpredictable as far as what the dollar's role is here. And a lot depends upon which way foreign leaders decide to go, which way central banks decide to go. Essentially, this has been a game of chicken between foreign governments and central banks, and it's almost the old expression of if you owe a lot of money to the bank, then you essentially own the bank. And therefore, that's been in the position we've been in over the last 5 to 10 years. But now it's gotten to such an extreme position, and we've so taken advantage of that position, the foreigners are going to say no mas, just like Roberto Duran, the famous boxer, said, no more. And so this new system is going to be reconfigured. The dollar is going to decline dramatically. It's very possible that we start issuing debt denominated in other currencies rather than the dollar. It will result in a dramatic standard of living decline for the U.S., and it will result in a funding crisis. It will result in higher interest rates that Americans have to pay, and it will result in closing down of massive consumer infrastructure and therefore massive increases in unemployment. That's where we're headed.
Is this the early stages of a depression in the United States, would you say?
Yes, I believe it is. Yes, we saw a extreme decline in economic activity, over the last until March or so, and then we've seen a pickup because things have gotten less bad. However, it really hasn't increased the slope very much in terms of economic activity. There's been a lot of funny statistics in terms of new home sales that are going up June over May, July over June. Those numbers are going up a little bit because seasonal impact of more people buying homes in the summer. People are buying $300,000 homes for $170,000, and therefore it looks like the numbers are getting better. It looks like unemployment is slowing its rate of increase. However, John Williams from Shadow Stats has pointed out that some one-time factors there relative to the auto industry and their shutdown for reconfiguring of factory lines has created some distortion there. There's been a lot of funny statistics. However, the economy is still in decline. It's become a little bit less bad because, as Chris Martenson has said, we're spending free money with all these incentives. But once these incentives are taken away, then the economy is going to continue to decelerate downward, and we're just getting started, unfortunately.
How about commodities, David? Are they not very inexpensive as a group, historically adjusted for inflation? How will they perform if, as you say, we will break the lows at some point in the future? Can that group hold up? We're floating around 250, and on a historical basis, that's fairly inexpensive, I think, adjusted for inflation, is it not?
I don't have those overall statistics at my fingertips, Eric, but I'll tell you my view on commodities. We believe that economic activity is going to decline further, and therefore various commodities that are dependent upon economic activity are going to suffer pressure: copper, oil, natural gas, etc. However, on the other side of that, if they're denominated in U.S. dollars and people try to move away from, as far as the Chinese and BRIC countries, etc., from holding U.S. government bonds, frankly, they'd rather hold copper because it does represent, a better store value than decline in U.S. government bonds. Now, we think precious metals are far better than base metals and oil, etc., because they represent a store of value and they have a currency component. That's why we like gold, silver, platinum far better than we like industrial commodities. However, there's this tug of war between the negative trend for industrial commodities from economic activity decline and then a positive trend from the store of value in terms of a declining U.S. dollar. Gold and silver we like far better because, frankly, we're still in this tug of war between deflation and inflation. The great thing about gold and silver is they do well in inflation, yet they also do well in deflation. Gold represents the one asset that's not someone else's liability. And even in this big deflationary collapse that we suffered in 2008, when